Thanks for clicking. All eyes were on Stats Canada this morning as it was set to release Canada's final inflation reading for 2022, with many economists predicting that we would see a lower inflation rate thanks to lower gas prices and improving supply chains. We got our answer this morning when Canada's CPI reading came in at 6.8%, about 0.1% higher than many were expecting, with core inflation coming in higher than many were expecting as well. The release of Canada's hotter-than-expected inflation rate comes on the heels of the Bank of Canada Governor Tiff Macklem conducting a year-end interview with the Globe and Mail where he said that the bank missed the mark on inflation.
You think?
Indeed, with the price of groceries skyrocketing, real estate prices plummeting, and more predictions of a recession into 2023,
Merry Christmas!
missing the mark is definitely an understatement. But during the interview, the governor did offer some guidance as to what the bank is thinking going into 2023. So what I want to do today is go over Canada's inflation rate for the month of November, take a look at Governor Macklem's interview with the Globe and Mail and what the bank is looking for in 2023, and then discuss some final thoughts going into the new year. This is my last video of the year as I will be going on holidays until January 9th. We've gone over a lot this year, and we've poked some good-natured fun at the Bank of Canada, real estate agents, and the banks, and we've poked some not-so-good-natured fun as well.
I think he's talking to you.
We'll continue to do so going into 2023, following the Bank of Canada, its path of interest rate hikes, and Canada's real estate market. Click like and subscribe if you want to get those updates, but for now, let's get into this inflation rate. As mentioned, Canada's inflation rate came in hotter than expected at 6.8%. Though gas prices fell in November, as expected, this fall in prices was offset by a rise in mortgage interest costs and rent costs. Mortgage interest costs were up to 14.5%, compared with 11.4% in October, and the rent index was up to 5.9%, up from October's 4.7%. But the real read, the most important read, as we'll see later, is that core inflation accelerated in November, accelerated to 5%, up from October's 4.9%. The core inflation reading removes the most volatile items out of the CPI basket, so we really want to see those numbers coming down. And as we'll see, that is where the Bank of Canada is focused in 2023, is our core inflation numbers. During his interview with the Globe and Mail, Governor Macklem went over the usual talking points that we've covered so much on this channel. Russia-Ukraine, supply chain issues, errors in the past, etc.
Usual shit. Wasn't my fault.
So I don't want to spend too much time talking about that. But the governor did offer us some guideposts as to what the bank is thinking for 2023, saying that by spring, once the snow melts, we're going to start to see measures of core inflation start to come down in a meaningful way. So the prediction coming from the Bank of Canada governor is that by March, by April, we should start to see that measure of core inflation, those measurements that accelerated in November, start to go the other way.
I can't wait that long.
But the governor also admitted some past mistakes that were made nearly a year ago, when the bank relied on the CPI common measurement, one measurement out of the core inflation measurement, when it chose not to raise interest rates in January. The governor mentioned at that time the CPI common measurement was showing a 2% inflation rate, which was later revised to actually 4.1% inflation, so the Bank of Canada chose not to raise interest rates in January, thinking that our CPI common, a portion of the CPI core, was only running at 2%, when in fact the economy was running much hotter than they thought. The interviewer then asked Governor Macklem if it was the models that failed the central banks when they didn't see the hotter than expected inflation coming, or if it was their judgment that failed. And while this interview wasn't videoed, so we can't see the expression on Tiff Macklem's face, I can imagine it wasn't a happy one.
Is the governor in control?
But we don't have the video, just the text, and Governor Macklem responded that the course of history will have to decide, and that we're not through this yet. But given that inflation peaked at 8.1% in the summer, and core inflation continues to accelerate, I think history will judge that the central banks were a little late to the party. So, in summary, during his year-end interview with the Globe and Mail, the Bank of Canada governor mentioned all of the usual talking points with Russia and supply chains, blaming those for the inflation problems that we've had throughout the year. He also admitted some problems with the data, relying on false indicators back in January. And he said that the bank will be looking to core inflation, looking for the core inflation rate to have gone down in March, April, when the snow is gone. And I think that's probably a good timeline for us to be judging the effectiveness of the interest rate hikes that we've seen since the beginning of last year. Interest rate hikes can take about 12 months to 18 months to work their way through the economy before they can start having an effect on prices, before they start having a real effect on everyday prices. Come March of this year, it will have been 12 months since those interest rate hikes started, and we'll be able to at least begin to judge the extent to which they're having their actual effect. I'm not saying that 25 basis points that we saw in March will be enough to bring inflation back down to 2% by March of this year, but it will be the beginning of the period that we're able to judge the extent to which these interest rate hikes are filtering their way through the economy. The readings from today show that the core CPI, the CPI that the Bank of Canada is focused on, is continuing to accelerate. And if the readings from today continue into January, into February, if core inflation remains sticky, then I would expect the Bank of Canada to continue to raise rates into 2023. Probably not by 400 basis points. I don't think the economy could handle that, not even close. But if that core inflation rate does continue to go up, as the Bank of Canada governor has said in the past, I think the bank will continue to raise rates into next year. We will obviously continue to have updates out on what the Bank of Canada does in 2023 on this channel. Merry Christmas to everybody and happy holidays, etc., etc. Click like and subscribe if you want to get those updates next year, and thanks so much for watching.